Chapter 13, statement of cash flows. Was that a question, or we're good? Okay. Chapter 13, cash flows. Remember, we've had this conversation early in the semester. Because of the accrual method of accounting, remember, in accrual, you can have a sale and record it as an accounts receivable. Did you get cash? No. You can have an expense and it become an accounts payable. Did you pay cash? No. So you can have a company that can have a lot of net income and a lot of accounts receivable and not have enough cash to pay all its bills. Okay? So the statement of cash flows is another analytical tool. It is a report that's presented by the company so that people can analyze to see if companies are pulling in enough cash to continue to operate. Okay? You need cash to keep the doors open, to pay the bills, pay your employees, pay for material, all that stuff. So it's very important. Questions? Cash does great things. Pays dividends, replaces assets, expands operations, all kinds of stuff. Okay? So we're going to focus on how to calculate or complete a statement of cash flows, but I want you to think about some things first, a little bit of some building blocks. Remember when we created a classified balance sheet? And in a classified balance sheet, we have current assets, non-current assets, current liabilities, non-current liabilities, right? So in assets, what's the standard by which we list the assets in order, the current assets? What's first? Cash, right? So, and everything else was how close is it to turning into cash? Accounts receivables first, then inventories, then your prepaid assets, and so on, right? So they were listed in the order of what is cash and when will it become cash. We're going to use a very similar concept with the statement of cash flows because it's either going to be cash or it's going to be some sort of cash equivalent, okay? Or it's going to be whether or not you've used up or provided cash to the business through operations. So, okay. Cash is cash. Cash equivalents are what? Checks, credit cards, anything that is for all intents and purposes the same as cash. You guys ever see those movies? It's some sort of a thriller movie where these guys are going to break in and rob a bank or something, right? Or they're going to rob some company. Die Hard. You guys remember Die Hard? Those guys broke into a building to steal what? Bonds. But they were a specific kind of bonds. They were bearer bonds. Typically, you know, a bond is a promissory note. I promise to pay to the holder of this, blah, 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 X number of dollars. Usually it says, I promise to pay to Joe Schmo $1 million on such and such date. A bearer bond says, I promise to pay to whoever has this in their hand. It's not traceable. So they don't know who you stole it from. Okay? So that's definitely a cash equivalent. It's worth cash. Okay? Long story short. There were some definitions here, though. So things that are cash, they're short-term, highly liquid investments, stocks. They're easily turned into cash. Stocks, you can sell them today, get cash tomorrow. Or it's a bond that is so near maturity that its value is not going to be affected by interest rate fluctuations. Right? Remember we went through the whole bond calculation? Stated interest rate's 8%, market is 10%. People are going to pay more for it. If it only has 10 days to go before it matures, is the difference in market rate going to affect it much? No, because the face value is pretty much going to be what they're going to get. Okay? The statement of cash flows is broken down into three parts. We've talked about these briefly. I haven't focused on them too heavily yet, though. So the statement of cash flows focuses first off on cash used up or provided by operating activities. What are the operating activities? Michael? I'm going to
Selling everyday goods.
It's the business that you're in, to make it simple for you. Your operations is the operating activities of the business that you're in. So if you're in business to manufacture and sell automobiles, the whole process of manufacturing automobiles, getting the parts in, manufacturing, and selling them is your operations. If you lend money to somebody else, is that part of your operations? No. If you borrow money, is that part of your operations? No. Okay, so that's what operating activities are. Investing activities are when the obvious one is if we make a short-term investment and buy some stocks or securities in another company. But the non-obvious one that I want you to make sure you remember is when the company buys equipment, buildings, trucks, the things that they need to use to run their company, those are all part of your investing activities. You're investing in your own company. So when you buy those things, you use up cash. And when you sell off the old ones, you're getting rid of them because you're going to get new ones, that you're getting cash in exchange for them. So they can provide cash when you sell them. Okay? Notice I'm using the term provide cash and use up cash, right? A lot of times they're referred to as source of cash or use of cash. We're all focusing on the cash here is really the key issue. So those are your investing activities. Financing activities are your typical borrowing. Okay? So if I go to the bank and borrow money, it's a financing activity. If I go out to the market and I issue bonds, that's a financing activity. The one people tend to forget, though, and it's the really obvious one, every company has stock. And that is how they all get started, and that is a number one financing source for the company. So the selling of shares is a source of cash for the company. Buying back treasury shares is a use of cash to the company. Paying dividends is a financing activity. Paying dividends uses up cash. Okay? Questions? So those are the three sections: operating, investing, and financing activities. Good? No questions. I must be doing good tonight. Examples of cash flow stuff. Not that I want to spend a lot of time on this slide because I think we kind of covered it. Operating activities, sources of cash. When customers come in and buy something, they give you money, right? When you pay your expenses, like the utility bill, or you pay your employees, that's a use of cash, and that's part of your operating. Investing, selling of assets is a source of cash. Selling of, like if you bought stocks or something. A loan, if you lent somebody else money, that's an investing activity. It's not a financing activity to you. It's financing to them. It's investing for you. Uses of that cash in the investing category, when you go out and buy new equipment or a new building, or you go buy stocks or you loan money to somebody else, cash goes out. Okay, cash goes away, that's a use of cash. And financing, the big ones, like I said, issuance of stock and bonds is a source of cash. Paying dividends is a use, repurchasing of stock, treasury stock, and paying off debt. Okay? Real quick. All right. Thank you. Okay, so here is an example of a statement of cash flows. And I just want to point out the big sections that we've been talking about. Every statement of cash flows is going to start with operating activities. So you've got operating activities and you come to this line, net cash provided by operating activities. It could be used by if it's a negative number, right? But in this case, this company its operations are generating positive cash flow, which is good. You're bringing money into the business. In cash flows from investing activity, net cash used by investing activities. Notice the change in term here. It doesn't say provided by, it says used. So we spent $3.4 million on stuff for the company, equipment and whatnot. And we can look at the detail here. Not going to right now. Then you've got financing activities, cash flows from financing activities, purchase of treasury stock, proceeds from issuance of new stock, net cash used in financing activities. So I'm expecting this to be a negative number too. Oh, it's not. I love it when the slides are right. Right? So I have proceeds of $950 and purchase of treasury stock of negative $305. I have actually a source of cash, or source of cash. I have net cash coming into the business, right? So this should say cash provided by financing activities. Everybody with me? I know it's nice and warm outside. Everybody with me? Okay.
So should we change the...
You should.
words?
Yeah.
Whether it's...
Yeah. And a lot of times I see it done as net cash provided / in brackets used. It's telling you if it's negative, it's used, so it's one or the other. This is the more formal way to do it. Okay, so net cash, net increase in cash and cash equivalents. You take the operating, finance, or investing and financing, add them together. So my total cash changed by $32,643,000. It went up. That's good, right? So we have more cash in the company than we did at the beginning of the year. The next line is cash at the beginning of the period, 51 million bucks. Add the 51 to the 32, you get cash at the end of the period. So cash went from 51 million to 84 million. It's a good thing, right? It's going the right direction? Okay. So let me take a second here. Remember that there are how many financial statements? 4. They are, in order, the income statement, statement of stockholders' equity, balance sheet, statement of cash flows. And remember that income statement, net income flows into the statement of stockholders' equity. The balance of statement of stockholders' equity flows into the balance sheet. Where does this guy sit? Is he an orphan? No. See this cash at the end of the period? This cash amount is and will be the same amount that you show for cash on your balance sheet. So this ties back into that one, into the balance sheet that way. Good? Okay.
So if it was net cash used in financing activities, that number would just be in parentheses?
Yes. Notice how net cash used by investing activities is negative. Okay?
Yeah.
So cash coming in, cash going out, cash coming in total. And there's bits and pieces to it. Okay? Let's walk through it since you asked, okay? Just for fun. I kind of covered the financing activities, right? We bought some treasury stock. We sold some new stock. That's all of our financing activities. No dividends or anything like that. Investing activities, we bought some property, plant, and equipment. So we bought some stuff, a building, some equipment, whatever. Okay? So we spent $6,658,000 doing that. Then we have proceeds from disposal of equipment and stuff. We sold a bunch of stuff for $167,000. Do we know what we sold from this? No. Could it be in the footnotes? Probably. Okay, maybe. Purchase of short-term investments. We bought some stock on the stock market because we had some extra cash. So we used up $109 million. Proceeds from sale of short-term investments. And these may be the same investments, they may not, we don't know. But we turned around and we sold them, and we had $112 million come into the company. And that gives you your total. We ended up using money on the investing side primarily because we bought $6.6 million in property, plant, and equipment. Good? Okay. Yes, ma'am.
So pretty much we will see, we're not always going to see those five specific activities. It could be other five as long as they're investing activities and then
Right.
other than that.
Maybe you didn't buy any new equipment this year, but you did sell some. So, this one wouldn't show up and the next one would. Use the ones that you need. Okay? I'm going to skip the operating because we're going to dive into that in a lot more depth. Okay? So let's push ahead, unless there's more questions. All right. Under GAAP, there are two ways that you can calculate the cash flow statement. There is the direct method and the indirect method. In the direct method, you sit there and you track the cash that goes out and the cash that comes in from each of these activities. So all year long, you're basically keeping your income statement on a cash basis, in addition to doing it on an accrual basis for GAAP. A lot of people think that's too hard to do, so they don't do it. Actually, just about everybody does the indirect method. Okay, I think the direct one is better. It's just a lot of work. The indirect method, what we do is we start with net income from our accrual income statement, and we go back and we adjust from that accrual method back to a cash method. And we do it manually, and we only do it once at the end of the year. And that's the method I'm going to walk you through tonight. Okay? No matter which one you do, you end up with the same cash provided by operating, cash used by financing, and so on. You end up with the same cash at the end of the day. You get to the same place. Okay. So we've kind of talked about this. I want to hit on it again because we're going to dive into this really deep in a sec. Let me get out of your way. Examples. Cash flows from operations. When you sell something, the customer pays you, you get cash, right? When a customer owes you money on accounts receivable and he sends you the money, you get cash. When you buy inventory, you use up cash. When you pay your expenses, your wages, your utilities, you use up cash. When you pay taxes or you pay interest on debt, you're using up cash. Okay? Notice some of these are financing activity down here, right? Okay. Oh, I'm sorry, interest on liabilities. This is different. And I got to be clear on this. Notice this is under operating activities. If you, has anybody ever noticed this at the job they have? You go out and you buy things and the vendor gives you credit terms, net due in 30 days, and if you don't pay them, they charge you a finance charge. That's what this is referring to. You didn't pay your accounts payable on time, so they charged you a finance charge. It's not really a note from the bank where you're borrowing money or a bond payable. So because it's a finance charge, it's an operating activity. Okay? I just want to clarify that since I explained it wrong the first time. Okay, investing activities. Selling in equipment, selling in investments, okay, stock in some other company, stock exchange, or buying either of those things uses up cash. We covered that. Financing, notes, stock, borrowing money, issuing new stock is a source. Paying off creditors, which is paying off debt, buying back shares, paying a dividend are all uses. Moving on. So, the book does it in a very formulaic way. They use these formulas to sit and figure out how much cash you got. I'm going to walk you through what I think is a much more common sense approach, and we're going to tackle it. But here's a great way to think about it. Remember our old formula, assets equals liabilities plus owner's equity, right? The basic accounting equation. Okay. If you think a little bit further down the road, this statement is true. The difference in your cash from beginning to ending is the same as the difference in your liabilities plus the difference in your stockholders' equity minus your non-cash assets, i.e. your investing activities, kind of, right? Your property, plant, and equipment sort of thing. Okay? That's the formula way to do it. I'm going to try and teach it to you a little easier than that, hopefully. Here's the rest of the formula. I'm even going to skip it because it's in the book and you guys can go read it if you want. But you have to remember that collecting accounts receivable increases cash. Everybody knows that, right? Paying accounts payable decreases cash. Cash goes out the door. Paying rent, cash goes out the door. Paying interest, cash goes away. Selling something for cash, we get cash. Notice how I'm thinking about this. It's all around cash. It's a 360-degree view of cash. Is it leaving? Is it coming? Purchase equipment, cash goes bye-bye. Selling securities, cash comes in the door. Paying off debt, cash goes bye-bye. Issuing stock, we're selling stock, we get cash. It ties in very neatly with my concept of debits and credits. What'd you give up and what'd you get? Right? Okay, so in the indirect method, you start with net income. That example cash flow statement I showed you a few minutes ago was a indirect. It started with net income. The first thing you got to do is analyze the changes in your assets and liabilities and your non-cash expenses, and you add or subtract them from net income. And the whole point is, what happened to cash? Converting your net income back to cash. I'm going to give you what I hope is an easy example. Make up a company. Let's say we have sales of $100,000. Good, right? Does that mean I have $100,000 in cash come in the door?
No.
No. Okay. I have sales of $100,000, but at the end of the year, my accounts receivable balance is $30,000. How much cash came in the door? $70,000, right? So I know I sold $100,000, but I still have $30 in accounts receivable. The rest of it must have been cash at some point. Good? So that's the basic concept we're going to work with here tonight. This is in the book. This is the formula method, Eric. That worked well. Okay, so in the book they're looking at current assets. If your current assets increase from last year, it lowers your net income. Right. You're thinking, huh? And I have to remember this. If my current assets decrease, I add it to net income. Huh? If my current liabilities increase, you add it. If they decrease, you subtract. Huh? What does this mean? This is painful even for me. Okay? So let's do it the easy way. What I think is the easy way. Here we go. Simple balance sheet. You need a comparative balance sheet to do this. Notice I've got 2008 and 2009. And it's just a balance sheet, right? Current assets, current liabilities. And all you need to do is look at what it is and calculate the difference between the two. So my cash was $51 million. It went up to $484. Did cash increase or decrease? Increased. Positive. Okay. Short-term investments. I had $3 million invested in the stock market. Now I have none. Where did that go? What?
You most likely sold it off.
My asset decreased. Okay. Hang on. It's an investment. we bought some stock, and it went from 3 million to 0. What happened to it? I must have sold it. If I sold it, what did I get? Cash. So notice if my asset balance decreases, I got cash. Good? You follow me? You will in a second, I hope. Accounts receivable was 49 million bucks. It went up to 53. So does that mean I collected more money or not? I collected less money. So my balance went up, but that's a use of cash because I did not get the cash. So if I'm starting with net income, if I have net income of 40,000 bucks, okay, and I sold my short-term investments, cash went which way when I sold it? Cash went up. So I would add 3 million, or I'm going to call it 3,000 here, okay? My accounts receivable, if I collected all of my accounts receivable and the balance didn't change, that means all of my sales became cash, right? But it didn't. So I have accounts receivable, the balance went up, so I did not collect all the cash, so it's a use of cash of $4,500. Let me try it a different way. Let's stop and think about net income for a second. In a cash basis accounting system, if I have sales of $100,000 and expenses of $80,000, my net income is how much? 20. So I had, think about it, cash basis, sales of $100,000 means $100,000 came in the door in cash. I had expenses of $80,000, that means $80,000 went out the door, right? So my cash at the end is $20,000. Okay. Now, in an accrual system, I have net income. And we're going to pretend that that's how much cash, net cash came in versus went out in operating activities, right? Same thing as the cash basis. But there's some adjustments I need to make, which is accounts receivable and accounts payable. Because I didn't collect all the money, or I collected some of last year's money, right? If I collected some of last year's money, I would have more cash than the net income implies. Correct? And if I paid off some of last year's accounts payable expenses, it would imply I have less cash than net income implies. You guys see how this works? Okay. Am I kind of getting through here a little bit? Just a little bit?
Confusing is that you're adding, but that looks like it's subtracting.
Okay. And you're right. Let's think this through. My balance in this account went down, so I recorded as going down. My balance in this account went up. My balance in this account went up. My balance in this account went down. All those things mean nothing until you look and see what the account is and what its effect is on cash. So the short and simple rule is, in the asset section, a negative increases cash and a positive decreases cash. When you get down to liabilities, accounts payable went down, so it shows that it went down. But if I paid off some of last year's expenses, do I have more or less cash? Less. So up here, it reverses, and down here, that truly is, a negative truly is a use of cash, whereas a positive is truly an addition to cash. There's a simple way to look at it. So just look at the account and think, what is happening? Yes, ma'am.
And we're calculating those changes because then we're going to use those on the statement of cash flow.
Exactly. And we'll get there in a minute. But I want you to understand the analysis that I'm going through here. So my accounts payable went down by $1,700. Did I Did I use cash up? Yes. If my accounts payable went up, that means I didn't pay people. I recorded the expense, but I haven't paid them. So my cash flow is actually higher than what net income says it is. Okay? So you got to look at the direction that things are going. Accrued expenses went up. What that says is I kept the cash and didn't pay some folks, right? So I still owe them later. So my cash goes up. Good? Everybody's kind of with me here. All right. Okay, contributed capital went up. Is that a source or a use of cash? Source, right? I sold more stock. Retained earnings went up. Well, that's because of last year's net income, right? Okay. Questions so far? I want to make sure you understand how to just go look at these and analyze them. And think about what's happening to cash.
Is there a quick rule for stockholders' equity? Is it always the same?
Yeah, and there's so few line items down here that I always just kind of think through what's going on. Oh, treasury stock went up. That means I used cash, right? I bought treasury stock.
It would be green, but it would actually be subtracting. So that
Yeah.
is not
So that one doesn't fit.
very fast.
Yeah, you got to stop and think it through. Yes, sir.
So just get this right, on the asset side, if you have the negative from the former year, earlier year, it increases the net income, right? Negative difference? Increase.
It increases cash, not net income.
Cash, I'm sorry. Cash.
Okay?
Got it.
Here's a guy who does want to do the formula method like in the book.
No, not really. So, and then it's just the opposite with liability,
Right.
and then you have to think through the stockholders' equity, right?
Yes.
Okay.
And I promise you, you guys are all real sharp. If you stop and think about it, it's pretty obvious what's going on. You know, if your accounts payable goes up, you're keeping the cash rather than paying your bills, so your cash flow goes up, right? So you just got to think it through, and you know which way to show cash flow going. Other questions? Yes, sir.
I have a question on expenses.
Sure.
How that increases cash, because you pay your accounts payable down, that decreases cash.
Well, I want to pick apart your question a little bit.
Okay.
My expenses are all summarized in with my net income, that starting line. So I don't go through and analyze my expenses. I only analyze the balance sheet accounts
Okay.
for modifications, unless there's something that's a non-cash transaction. Anybody give me an example of a non-cash expense on the income statement? What's an expense you get to record but cash never left the building? Depreciation. Think about the entry. Debit to expense, credit to accumulated depreciation. Where's the cash? Well, the cash was spent long ago when you bought the asset. So the very first step in the process of calculating cash flow statement, start with net income, add back depreciation, any other non-cash transactions you may have, and go. Okay? Yes, sir.
I might be understanding this wrong, but so do the changes in the cash flow have any effect on the net income?
No. No.
I mean, it's the changes in assets, liabilities, and stockholders' equity that change the...
Let me say it, I think here's what you're saying, okay? The income statement is prepared first, the balance sheet second, the cash flow statement last, okay? So net income is already set in stone when I start the statement of cash flows. So net income is what it is under the accrual method, and then I go through the balance sheet and I look for the changes to look for the modifiers to net income to convert it to the cash method. Good? We're trying to convert back to the cash method of accounting. So did I pay it? Did I not pay it? That's what you're looking for. Other questions? Yes? Okay. So, simple income statement, you start with net income from the bottom line. Okay? That's income after taxes. Net income, bottom line. Good? And it records your revenues, which it's assuming is cash, and all of your expenses, which we're assuming were paid in cash. But we know they weren't. And now we go back and we try and modify that to the cash method. Good? Yes?
Now, what happens if the company doesn't report their cost of sales?
The expenses are included somewhere. If there is no cost of sales, then it's a service company, so all they'll have is operating expenses further down. Okay? Or if they have a very small segment of their business that has cost of goods, but they end up reporting it in, lumped in with other stuff, it may disappear, but the amounts are reported somewhere. Okay? All right. Here we go. Statement of cash flows. Who, what, and when. Cash flows from operating activities. Start with net income. There's that $24,000 from the other slide. Step 1, add back depreciation and amortization, because there's no cash that went out the door when you recorded that expense. So instantly you get a bump in cash from net income based on depreciation. Good? Okay. Then we go through and we look at the changes that took place in the balance sheet, not in the cash account itself, but in the other balance sheet items, and we add or subtract based on the analysis we do. So remember, accounts receivable from the other slide went which way? Up. So we didn't get all the cash, so we're going to subtract it from net income to derive the correct amount of cash. Inventory went up. That used up cash. Prepaid expenses must have gone down because we're now getting the benefit of that. We got to use up a bunch of prepaid rent without any cash going out the door. Okay? So cash flow would go up. Accounts payable went which way? Down. So our balance in accounts payable is lower than the end of last year, therefore we used up more cash than what net income is telling us. And accrued expenses must have gone up. We owe more people money because we kept the cash, so it's increasing our cash and cash equivalents. Everybody follow the basic concept? Yes? Kind of? So you end up with net cash provided by operating activities.